Welcome to the December monthly topical roundup. My name's Sharon Cook and I'm going to be talking about the tax issues arising today.
And I'm Julia Penny and I'm going to be talking about audit and accounting and anything which isn't, or maybe occasionally is, tax. For example, things like money laundering, Criminal Finances Act and so on.
Yes, I thought you were going to try and put them under the tax banner then.
No, that might be a bit of a stretch.
Yeah, well, criminal finances is an interesting one, isn't it? As we've talked about previously,
yes.
It does
overlap,
which is the whole purpose of having two of us in these chatty sessions so that we can cover all sorts.
Absolutely.
All sorts. But as usual, we're going to do tax first to get it done and over with, perhaps. Don't know. And of course, the big news in the last month, starting at row 1 of the agenda that you can download alongside this session if you would like to. So we have had the budget since the November roundup. So we have all the budget news. Yeah. So on the agenda, you've got the hyperlink, which will take you to the government budget pages, and all the maths budget information can be accessed from there. You've also got various web links to SWAT courses. So at the moment, I'm in the middle of General Tax Update Quarter 4, as I think you guys are doing A&A Quarter 4 at the moment, aren't you?
We are doing A&A Quarter 4 at the moment. And yeah, as usual, there's quite a lot going on. There's sort of developments in terms of new stuff coming out, plus how we deal with existing stuff and how we deal with that to get it a bit better all the time.
Okay. So with the general tax updates, if they've run after the budget date, we've been giving out our budget handout as well and talking about budget. So the GTU courses are still relevant. And I'm just thinking about the webinar recording. So the 3.5-hour one I did earlier this week, and that has budget in. And we're doing the 1.5-hour one next week, and that's got budget in as well. And of course, the day after these budget type events, we'll always do a rapid reaction webinar, which can be watched live or on demand afterwards. And that's available now as well. So all sorts of budget courses around. And what I've been doing just before we started today is I've made some notes on what I think was particularly interesting or key from the budget, and thought I would subject Julia to a bit of tax.
Yeah, well, I always like to hear a little bit about tax because, to be fair, I haven't sat and read through budget papers.
Well, there you are. It's like this session was meant to be.
Yes. So yes, tell me all about the budget.
I'll tell you about the budget. So some bits were known before, and I think it's fair to say some areas are more exciting than others.
As always.
But what I think is turning into talking points on courses, we've been talking a bit about 100% first year allowances. Different to the 100% annual investment allowance. So the annual investment allowance and writing down allowances, or your core capital allowances as such, nothing's happening there. Not on the surface anyway. Although, as I think we talked about last month before maybe now, we have got this call for evidence going on about whether plant and machinery capital allowances should be replaced with depreciation.
Indeed. And we talked about the difficulties potentially of that happening in terms of delaying the tax relief if you slow it down to a depreciation rate instead of, an annual investment allowance or first year allowance. So what have they said about first year allowances then?
So, well, nothing that exciting then, where the 100% first year allowances are concerned. So when I've got my groups in front of me, I always say, has anybody ever had a client claim a 100% first year allowance on a zero emissions goods vehicle? And they always go, no. So I don't know if anybody in this session has ever had a client claim a first year allowance on an electric van. If you have, let me know. It'd be very exciting news. But on the basis nobody's doing it, I don't think it's actually too exciting to hear the allowance has been extended for 3 years to take us up to 2021. But the reason I mention it at all is if we were to go back 3 years and we were having similar conversations about electric cars, at that point people were saying, no, my clients are not buying electric cars, no. Whereas now it's almost becoming the norm. We're seeing more and more in the way of electric cars with the way technology is developing. Yep. And it's possible the vans will go the same way, and perhaps we will see more electric vans around, and perhaps the availability of the 100% first year allowance will be of interest.
Yeah, so it's quite an interesting development. I was lucky enough to be on holiday last week in sunny Portugal. This is relevant, honest. And the car that we hired was a hybrid electric car. So you turn it on and nothing happens, only it does. It's just silent.
Wow.
And so you're thinking, well, okay, this is starting to get quite mainstream. So as you say, maybe there will be a shift quite soon.
You never know. Now, that said, even if we did see that shift, we're only going to be excited about the 100% first year allowance if it's a business that has run out of annual investment allowance anyway. So it's that kind of level. They're also extending out the categories of water saving and energy efficient plants that qualify for 100% first year allowances. But again, we don't see a great deal of that while the annual investment allowance is sitting at 200,000.
No, it does take care of most businesses' needs, doesn't it, from a capital investment point of view, I imagine.
Yeah, I think that's fair. Though an interesting point that came up during the budget, not that it's new news as such, but it was an interesting reminder, is that if a limited company claims a 100% first year allowance on something like energy efficient plants, even if it's got available annual investment allowance, if it goes down the 100% first year allowance route and it makes a loss, it gets an extra loss relief option. So the 100% first year allowances for companies go hand in hand with a repayable tax credit. Now, if you can take your loss and set it against other income of the current year, carry it back to the previous year or group relieve it, you're going to be better off doing that. But for a company whose only choice is to carry a loss forward, it's really interesting just to remember there is this other option to say, do you want to surrender it to the revenue, give up all future rights in return for a cash payment now? Now, what they've said at Budget Day is corporation tax rates have come down in recent years, as we've seen, but this repayable tax credit rate has stayed put at 19%. So now that corporation tax has come down to 19%, they've actually levelled out. And that is not where we want it to be. So they've now changed, what they're proposing to change the legislation to say the repayable tax credit will be set at 2/3 of the corporation tax rate, to always keep it slightly less than the main CT rate. So you can carry it forward in the hope of getting full relief, or you can cash it in for a lower rate now, but you've got cash in hand.
Yes, and the cash in hand is often very important, isn't it, for businesses in that sort of position?
Yeah, if you're loss making, that can be an interesting little facility there. So I just thought it's worth reminding us all that repayable tax credits are there and they do exist.
Indeed.
So that was exciting point number 1.
Yep.
I'm overselling it, aren't I?
Maybe.
Brace yourself, we're now going to get into landlords. Now, landlords are